you are our title partner for today's event. So thank you very much to Green Street for their tremendous support of OZ Pitch Day. This is your very first participation in OZ Pitch Day, and you came in as our title partner this time around. So many thanks to you for helping to make this presentation possible today.
Jimmy, yes, thanks so much for hosting us. Really feel honored to be the title partner at OZ Pitch Day, and great to be here. My name is Joshua Greenberg, as Jimmy mentioned.
I'm Daniel Greenberg. The two of us are principals at Green Street. We are ground-up multifamily developers in Brooklyn, so very simple. We've completed 5 ground-up multifamily buildings in the past 8 years. And we are here today to tell you why our latest deal, the Metropolitan Assemblage in Williamsburg, Brooklyn, is the best deal that we've ever been able to do, and consequently the best deal that we've been able to offer to our investors. And there are 2 major reasons for that, which I'll get into. The first is we were lucky enough to get a 50% upzoning on the land. And the second is that it's in a rare OZ tract located in Williamsburg. So I'll go through each of those 2 in a little bit of detail. The first is the fact that we got a 50% upzoning in the land. So we signed the contract on this land last year for $22 million. While we were in contract, New York State passed a program called 485X, which replaced an older program called 421A. The basic point there is the program gave us a 33% boost in the amount of buildable square feet we could build, which was great because we underwrote the deal at about $310 a square foot, which we were very happy with. Land in Williamsburg usually trades for around $350. So from day one, we were doing very well. But then after that, we got this 33% bonus in floor area. We then proceeded to close on the land, and New York State then passed another upzoning in December last year called City of Yes, which gave us a further 10% boost in the amount of buildable square feet. It did a few other things, like it increased the height limit from 8 floors to 11 floors. It got rid of parking requirements, which enhanced the economics of the deal. But altogether, as I mentioned, we underwrote the deal at $310 a square foot. And now we're in at a cost basis of $210 a square foot, which again, in a market which trades at around $350 a square foot, is a major advantage to start with on day one. Put another way, we bought the land for $22 million. After the first upzoning, the bank valued it at $32 million, and now the value is at around $35 million. So we have a $13 million built-in gain from day one, ready to go.
And what that means for our investors is for every $1 million that an investor invests, on day one, the investment is worth 1.2 million. So it's effectively a 20% boost right out of the gate, and that's just a fantastic start for our investment.
The second reason why the Metropolitan Assemblage is the best deal that we've ever been able to do is it's located in a rare opportunity zone tract in Williamsburg in Brooklyn. So for those people who are not necessarily familiar with all the different neighborhoods in Brooklyn, Williamsburg is probably the most attractive, sought after neighborhood in Brooklyn. Anyone who's in their 20s and 30s, who's coming out of college, coming out of grad school, moving to the city for a job, wants to move to Williamsburg. It's hot, it's trendy, it's got restaurants and bars, and basically everyone wants to move there, is moving there because that's where all their friends live, and that's where all the action is. In Williamsburg, we actually have another building 4 blocks away from the Metropolitan Assemblage, which we're renting for $100 a square foot. So that's roughly $5,000 for a 1-bedroom apartment. Condos are selling at around $2,000 a square foot. So it's really an already gentrified neighborhood that didn't necessarily need the opportunity zone incentive to incentivize development in the neighborhood. But for a few reasons, and we can go into that a little bit, it was classified as an opportunity zone. As everyone knows, the opportunity zone law was passed in 2017. Based on 2010 census data, and Williamsburg was only rezoned by the Bloomberg administration in around 2005, 2006. So it had just started to take off when the census was taken. But now, fast forward 20 years, it's an already developed, booming, bustling neighborhood. And when we tell people that there's an opportunity zone tract in Williamsburg, they just can't believe it. And so what this means is that investors have the opportunity to get all of the opportunity zone tax benefits, but don't necessarily have to take the risks that are ordinarily associated with developing in lower income areas or in rural areas. It's really sort of a best of both worlds situation.
That's absolutely right. Opportunity Zone was created to give incentive to real estate developers to build in areas which needed help. So low income areas, rural areas where economic activity was hard to come by. And that's why they decided to give the tax-free benefits to investors to really encourage growth in those areas. And now, as Dan said, we have an opportunity zone in an area which really doesn't need extra motivation for investors to invest in. And you really are getting the best of both worlds. You're getting the tax-free benefits of the opportunity zone, and you don't have to take the typical risks associated with investing in lower income areas. Just a little bit more about the investment before we go over to the video. We've currently raised $28 million. The total raise for the deal is $33 million. We have $5 million available. The investment minimum is $100,000. We offer a 17%, roughly 17% IRR, direct IRR, which equates to a 22.3% pre-tax equivalent IRR on the deal, and the equity multiple on the deal is 4.2 times. We'll get into that a lot more detail about that later, but Jimmy, if I can ask you, could you play the Metropolitan Assemblage investor video? We prepared a video which explains a bit more about the development, and then we'll get into the investor deck. The Metropolitan Assemblage is hands down the very best deal we have ever brought to our investor base.
The land price was negotiated and secured just a few weeks before the announcement of the new 485X New York housing program. The new program, which is fully elective, offers developers a 35-year real estate tax abatement and a 33% increase in buildable floor area.
These benefits are in exchange for allocating 20% of the apartments to slightly below average income tenants at below market rents. It's a highly attractive offer.
This resulted in a land basis of only $226 a square foot, in a market where land typically trades at around $350 a square foot.
The deal is also located in an opportunity zone in Williamsburg in Brooklyn. Williamsburg is both one of the most desirable areas in New York City and one of the most desirable opportunity zones in the country.
It's exceptionally rare to find a development opportunity which is both in an opportunity zone and which is in an area where condos are trading at over $1,600 a square foot, and where a new two-bedroom apartment, for example, would typically rent for $6,000 a month.
The development plan includes 3 buildings with a total of 132 apartments. The total cost is projected at $82 million. The value at completion is projected at $135 million, and this implies an impressive margin on cost of 65% and a development profit of $53 million. There is also the 2-phased aspect to the deal. After completing phase 1, we will be able to refinance the completed building, withdraw all of the equity that we invested in phase 1, and redeploy it back into phase 2, really maximizing the use of the invested capital.
This means that in year 5, when phases 1 and 2 are complete, we plan to return the full amount of investor capital back to our investors without diluting anyone's ownership in the deal. The deal also has a 10% preferred return, and only after that do the sponsors share in any of the surplus profits. The projected net IRR to investors is 19%. Since it is OZ, these returns are effectively tax-free, meaning that the pre-tax equivalent IRR is 22%. This means that a $1 million investment is projected to produce about $4.4 million in proceeds over the 15-year period. The pre-tax equivalent equity multiple is 5.4.
This would be an extraordinary investment outcome for even the most demanding of real estate investors. Okay, so this is the site. This is the site on Metropolitan Avenue that's currently there. A bit of background about the acquisition of the lots is that it was the Crest Hardware. It was a family that owned and ran a hardware and nursery business for more than 60 years. They had a large amount of land on this road, and they were all retiring, 4 brothers, and this was the time they chose to exit. So what we'll be building is 2-phased development. So phase 1 is going to be 70 apartments, and then phase 2 is going to be 2 separate buildings of 42 apartments each. We chose to do a 2-phased approach to this development, which has been very well received by our investors. So what it does for the investor is that we're able to, Opportunity Zone is a very long-term investment. It's a mandatory 10-year hold period. Developers typically make more money when you are developing as opposed to just holding an investment. And what this allows the investment to do is make 2 development profits back to back with 1 pot of equity. So what that does is that it gives our investors the chance to, as I say, make 2 development profits, and that contributes to the high IRR that we're able to offer our investors. We also do have acquisition targets. We do have some expansion targets in phase 1 and phase 2. We've done the projections and the return based on what we've initially bought, which is a fantastic return. If we do manage to get some of the neighbors, we'll expand either phase 1 or phase 2 or both. But we really want investors to consider the investment based on the numbers that we have in this deck, which are fantastic to begin with and are based on what we've currently bought. Anything else that we buy will enhance the returns, but it really will just be a bonus as opposed to what we currently have. This is where we currently are with in our architectural renderings. We plan to break ground in about June next year. This is what phase 1 is going to look like. Here's an existing floor plan. These are some photos of existing developments that we've done in Brooklyn. Green Street's been in existence for 8 years. This is our 6th deal in Brooklyn in ground up multifamily. It's all we do. We have a very rinse and repeat model. We've really optimized our process and our development to cater to this kind of tenant demographic and this kind of market. And we're going to send the deck is available on our website. Anyone can go there and download it. The video is also there if you want to watch it again. And we have a very detailed workup of the model and all the budgets, and we welcome any questions on any of the line items, how we came to the numbers that we came to, and we happy to get as much into the weeds with investors as they want. We really enjoy that kind of interaction. Dan, over to you if you want to just speak a bit more about Williamsburg.
Thanks, Josh. And again, we can get into more detail with investors. As I mentioned, Williamsburg is probably the most sought after neighborhood in Brooklyn. It's gone through just a profound redevelopment over the past 20 and specifically over the past 10 years. There were a lot of old industrial buildings that have since been demolished and replaced by beautiful luxury rental buildings. There's investments in parks, in parks, and you can see it's just a booming, bustling neighborhood. And part of the reason why Williamsburg took off like it did is this shows Williamsburg's proximity to downtown Manhattan. So just across the L train here, 2 stops from Williamsburg, and you're on 14th Street in Manhattan, which is just a short trip to either downtown or Midtown Manhattan. And so what you see is you have just thousands and thousands of young people who may work in offices in Manhattan but choose to live in Williamsburg because that's where all their friends live. And then our site in particular is in a it can't get better location than this. It's on the same block as the G train, which goes to Long Island City and Queens and then to Midtown. And it's on the same block as an L train subway, which is the main subway, which takes you to Manhattan. So it's really fantastically located. We completed another building about a year ago, 4 blocks away from this, and we're getting about $105 a square foot in rents. That translates to about $5,200 for a 1-bedroom apartment. This development is an even better location, closer to the subway. It's going to be a bigger, better building, more amenities, but we've basically projected the same rents that we're already receiving in a building nearby. Here we have some more information on the 4 partners. Josh and I are 2 of the 4. Warren Silverman is our director of construction. He's got 15 years experience in the industry, built 26 multifamily buildings in Brooklyn. So, when we say this is all we do, this is really all we do and all we focus on in this location. And I hope it's basically clear that, we have a strong track record in this asset class, in this location. And what people often say, and it's completely true, is that real estate is a really local business. It depends on who you know, the local lenders, the local contractors, and that's really what we've chose to focus on and what we've become absolute experts in. This on the left here is a 68-unit building in the neighborhood of Greenpoint in Brooklyn, which we just completed. The total cost there was $42 million, value of $60 million. So we're working at about a 40% profit margin on Metropolitan, which
that's right. And to add to that, on Freeman, we raised $18 million. 2 years later, the building's worth 60, and we've effectively doubled the amount of equity in the deal. So we currently at a 2x already, which is really, really fantastic. And we've managed to return 65% of invested capital back to investors. Another thing that we're really proud of in our business is that Metropolitan is our sixth development. We have about 30 investors in the Metropolitan deal. In our deals 1 through 5, we're very proud to say that every single investor who's invested in deals 1 through 5 has also now invested in Metropolitan, and that's bar none, and that's something that we really are proud of. Just to get down to a little bit more of the economics of the deal and our business, we have a very simple structure how we assign equity and economics in our business. So we have a 10% preferred return, which we give to our investors. And then after that, there's a profit split between the investors and the sponsors. All the numbers that you see in the deck are after the profit split. So you don't have to worry that there's anything that comes off these numbers. The other thing that's fairly unique about our business is that we don't charge any fees throughout the full duration of the investment. So there are no development management, there are no developer fees, there are no asset management fees, there are no refinancing fees, guarantee fees, exit fees, just no fees. We do put in the budget a project manager's salary, which is a 5-year salary for our director of construction, Warren, and he's on site 5 days a week. It's his only focus to look after and to make sure that Metropolitan is well executed. And there's a budget in there for that salary. But in terms of any other fees, we don't make a dollar of fees besides that. And our full economic interest in the project is in the amount of profit that it makes. So we have a very tight alignment with our shareholders in terms of incentives for this deal and for every deal that we've done. And then just lastly, to get into the numbers, page 3 of the deck, and as I say, the deck is available on the website, and we will send it to everyone afterwards. Page 3 is really the most important page. It really summarizes the roadmap for our investors, and what it really says is that for every $1 million that's invested, there's going to be these cash flow, these payouts on in each year. So in year 3, once we finished phase 1, we're paying out for about $490,000, and then at the end of year 5, once we finish phase 2, we're going to be paying out a further $790,000. What this means is that within 5 years, we're going to pay back about 1.3 times the invested capital back to our investors without diluting their shareholding in the investment. Your shareholding always stays the same as what it was when you invested. After that, there is annual rental income which flows to investors each year, and then once we sell, there's obviously a big payout. And what that means is that over the lifetime of the investment, we'll be producing a 4.2 equity multiple, or giving back 4.2 times the investment. So for $1 million, you can expect to receive $4.2 million over the lifetime of the investment. And what's so fantastic about this, and it wasn't the case on Freeman, but what's so fantastic about this deal, besides the fact that there is actually a cheaper land price than Freeman, but what's really so fantastic is there's no tax. Because it's in an opportunity zone, there's no tax on any of these cash flows. So all the cash flows that you see, all the income, all the capital appreciation is effectively tax-free. And what that really means is that you're getting a 4.2 equity multiple, which would mean if you went into a taxable investment, you would have to get a 5.8 equity multiple just to match what you're getting at Metropolitan. And that would mean that you would have to achieve a 22.7 pre-tax equivalent IRR every year for 15 years. That may be achievable for 1 or 2 or 3 years in a row, but to achieve that kind of IRR 15 years over 15 years, 15 years in a row, or to average out over 15 years is really just both the best deal that we've ever been able to bring to our investor base, and just an unbelievable return. No one would ever say that north of a 20% IRR is something that's not extremely attractive. So Jimmy, that's basically the end of our presentation. We would love to take questions from the audience. I'm not sure if we have time during this session.
We've got time. Yeah, we've got a few minutes left.
Okay, great. Yes, let's take some questions, and then we'd love to welcome everyone to the breakout session where we can answer as many more questions. We also, please reach out to us. We are available to do tours of our business, tours of our existing properties that we've built in Brooklyn. We can take you to the development site. You can get to know us, and that's more than welcome to do that. And reach out, and we can arrange a tour for anyone that's interested.
Perfect. Josh and Dan, thank you so much. As they mentioned, and as I mentioned previously, they are going to be joining a dedicated breakout session in about 5 more minutes from right now. I'm going to post a link to that breakout session in the Zoom chat momentarily. That's the way that you can go and enter into a more private room with just a few people. Probably a handful of you will join that. Here in the main session, starting in 5 minutes, will be our Ask the OZ Experts panel session. We'll get to that in just a moment. Gentlemen, we had quite a few questions on slide number 3, that cash flow example. Max just asked, In year 8 through 12, the cash flow drops below that year 7 cash flow, which is also post stabilization. Year 7, you've got $62,000, and then it drops in year 8 to $46,000. He's asking what accounts for that drop there.
So that's an excellent question. We have a 10% preferred return, and basically what that means is that our investors invest 30. The raise is $33 million. We've invested $3 million of our own money into this deal. So investors invested about $30 million into the deal. There's a 10% preferred return, which has to be serviced and paid back before the sponsors and the common equity shareholders get any of the funds. So what this is showing is that in years 1 through 8, the investors are getting more of the cash flows before we start sharing in the cash flows, and that's why it's elevated in the first in the first few years of rental, and then drops a bit.
Perfect. We had a couple people asking, Sandy and a couple others asked, what is the minimum investment? I think you stated $100,000. Is that correct?
That's right. That's $100,000. Yes.
Good. Okay, let's see. We had several questions about your new mayor, Mayor Mandami, who just was elected a few days ago, I believe. What investment concerns do you guys have given the newly elected socialist mayor of New York City's platform on affordable housing? A couple other questions about, do you think rent control will come into the equation here? What are your thoughts on the new mayor?
So yeah, that's a perfectly valid question, and we've got that question a few times in the last few weeks, as you can imagine. I'd like to say a few things about that. The first is the proposals to, quote unquote, freeze the rent does not apply to our business. That applies to apartments that are stabilized. Our projects are 90% free market, meaning fully free market. The city doesn't have any control over that. 10% of our revenue is affordable and stabilized, and that's part of a city program which gives us a 35-year property tax abatement, which is a terrific trade-off for us. But the important thing is, in terms of a rent freeze or rent control or anything like that, basically it doesn't apply to our business. And overall, our view here is it's important to separate rhetoric from fundamentals. And fundamentally, New York is a special place with unique strengths. It's a city of 8.5 million people in a metro area of 30 million people, and it really offers people and companies something that is not possible to replicate in any other city in the United States or really in the world. And that's the ability to attract and employ top talent at scale. So a lot of large companies are obviously very, very, very active in New York, and sometimes we hear them decamping to places like Connecticut. They think maybe the real estate, the rent is cheaper, the salaries are cheaper. But what we often find is that they land up coming back to the city because they simply can't attract the same type of talent at scale that they're able to attract in New York. If you just think about people graduating college, people graduating top MBA, top law school programs, probably a majority of them come to New York, and in that age bracket, probably half of those come to Brooklyn. So it's really a unique place that is not able to be replicated anywhere else. And another thing I would mention in terms of real estate values is that unlike a lot of high growth markets, you take Dallas, Texas, for example, unlike a lot of those high growth markets, New York has a supply constraint, which really drives real estate values. So in a lot of markets, I mentioned Dallas, Texas, that have high economic growth, high population growth, do you see high rental growth? And the answer really is over the past few years has been no. You've really seen rents drop because there is no supply constraint. As soon as rents creep up, developers can flood the market with thousands of units, which drives vacancy up and drives rents down. In New York and Brooklyn in particular, vacancy is between 1% and 2%, and we've seen solid, consistent increases in rents over the past few years.
Right, and then just to add to that, Jimmy, whenever there is a change something happens, people always speculate that, is this the end of New York? I mean, if you take 2001, for example, with 9/11, they thought, that might be the end of New York. 2008, they thought it was the end of New York City. Certainly during COVID, they thought this is the end of New York City. And, here we are 5 years after COVID, rentals are up 40%. And really the point is that New York, because of the fundamentals of what it is, it's very resilient to anything that comes of it. And certainly New York has had many mayors. Some of them have done great things for the city. Some have been poor and have not performed well. But the real crux of the matter is that New York is bigger. New York City is bigger than who the mayor is and how good they are during their term, because really the fundamentals make it that it's just not a place that you're able to replicate somewhere else. I mean, Florida, for example, has got Miami's got 1.5 million people, a metropolitan area of 6 million people around that city. New York has got 30 million people in and around New York City. It's just not possible for another city to accommodate that many people and for people really to move away from New York. And if you are a big Fortune 500 company, if you JP Morgan Bank or a top 5 hedge fund, and you want to hire thousands of people of top talent, the only place that you can do that and the place you can do it most effectively is New York City. So it's not a city that you can avoid.
Gentlemen, it's been a pleasure having you here in the main session. Thank you so much for your support as the title partner of today's event. And
thanks so much, Jimmy, and looking forward to answering questions.
Perfect. Thank you, gentlemen.